The average senior homeowner in America paid $4,271 in property taxes last year for most people. That number looked normal because it came from the county. And when a bill comes from the county, people assume the number has already been checked. But that is not how systems work. A system does not have to be evil to take money from people. It only has to be complex enough that the people inside it do not understand the rules. And for 92% of eligible senior homeowners, that is exactly what happened. They paid more than they legally needed to pay. Not because they were irresponsible, not because they failed to work hard, not because they were careless with their homes. They paid more because there is one form that can reduce that bill. And most of them were never told that the form exists. The ARP Foundation confirmed the size of the gap. About 9.3 million older adults qualify for a property tax reduction they are entitled to under law. Only about 8% have ever applied. That means the other 92% are overpaying every year. And the most important part is this: the government is not designed to stop them from overpaying. The government sends the bill, the homeowner pays the bill, the file closes, the machine moves on. There is no person inside the system waking up in the morning asking how many seniors in this county are paying too much, and how do we return the money before they even ask. That is not how the machine is built. But here is the part that matters even more. Some seniors do find the form. Some seniors do file it. Some seniors are legally eligible, and a large number of them still get rejected. Not because they do not qualify, because there is one section of the application that almost nobody completes correctly. The county usually does not send it back and say, "You forgot this. Please fix it." The county denies it. The application is closed. The filing window shuts for another full year. And the senior goes back to paying the same inflated property tax bill, often never understanding what went wrong. That is the real lesson here. The danger is not just that the benefit exists and nobody tells you. The deeper danger is that even when you discover the benefit, the process is still built with traps. So I want to walk through the structure carefully. I want to show you what the form is, how it works, how much money can be involved, why so many people never file it, why many applications get denied before they are ever meaningfully reviewed, and why in some states there is a retroactive angle that people do not see coming. Because when a rule is hidden in plain sight, the person who understands the rule has an advantage over the person who only works harder. Let me give you the human version of this. Take a woman named Carol. She is 68 years old. She spent 26 years as a public school teacher in Illinois. She bought a modest home outside Springfield in 2001 for $162,000 for many years. That home was not a luxury asset, it was just her house. It was where she came back after long school days. It was where she planned to grow old. It was the place that made retirement feel stable. But over time, the value of that home rose. By 2024, the county assessed it at $310,000. That sounds good on paper, but if you are retired and living on a fixed income, a higher assessment is not the same as more spendable wealth. You cannot buy groceries with the paper increase in your home. Assessed value, you can only pay the tax bill that comes with it. Carol's annual property tax bill reached $7,400. She paid it year after year. She paid it on time. That is what responsible people do. They do not want trouble with the county. They do not want penalties. They do not want liens. They do not want letters that make them feel as if they failed. So she paid. Then, in 2024, a neighbor mentioned something called the senior assessment freeze. Carol had never heard of it. That sentence is important. She was not hiding from the tax system. She was not ignoring the mail. She was not careless. She had simply never been told that a legal protection existed. She went to the county assessor's website and discovered that she had been eligible since 2021. That meant 3 years of overpayment, 3 years in which the county accepted her money, 3 years in which no one warned her, 3 years in which a simple application could have changed the math. Carol is not the exception. Carol is the pattern. When I look at systems, I look for patterns. I do not assume that one case proves everything, but when the same mistake happens to millions of people, it is no longer just a mistake. It is a system producing its predictable outcome. The ARP Foundation runs an entire volunteer program because what happened to Carol is happening all over the country. Older homeowners qualify for property tax relief. They do not know it exists, or they find it too late, or they file the wrong form, or they miss a document, or they miss the deadline, and the overpayment continues. The form is generally called the Senior Homestead Exemption. Some states call it the Senior Property Tax Exemption. Illinois calls it the Senior Citizens Homestead Exemption. The name changes from state to state, and that is part of the problem. But the mechanism is similar. Your county calculates your property tax based on the assessed value of your home. That assessed value is not always the price you paid. It is not always the market value. Exactly. It is the value used by the county to determine the taxable base. The senior exemption reduces that taxable value before the tax is calculated. If your home is assessed at $300,000 and your state exempts $50,000 for qualifying seniors, you are not taxed on the full $300,000. You are taxed on $250,000. That difference can look small when you speak about it in abstract terms. But property tax is not abstract when the bill arrives. A reduction in taxable value can save hundreds or thousands of dollars each year, and it can do it every year for as long as you own the home and remain eligible. Some states offer something even more powerful. It is called a senior assessment freeze. That is different from a simple exemption. An exemption reduces the taxable value. A freeze locks the taxable value. The day you file, your home's taxable value can be frozen at that level, even if the market value of the home continues to rise. That distinction matters because inflation and real estate appreciation can quietly push retired homeowners out of homes they already paid for. Your neighbor's tax bill may climb every year because the assessment keeps rising. Your bill may not climb in the same way if you filed the freeze correctly. That was Carol's situation. She qualified for both the exemption and the freeze. She did not know either existed. This is where people misunderstand fairness. They think fairness means everyone who qualifies gets the same benefit, but in the real world, there is a large difference between qualifying for a benefit and receiving it. The gap between those two things is often paperwork, and paperwork is one of the most powerful filters in any modern system. The savings can be meaningful in New Jersey. The maximum savings under the Senior Freeze program is $6,500 per year. That is not a rounding error for a retired person. That can be utilities, medication, insurance, groceries, or several months of breathing room. In Texas, homeowners age 65 and older receive an additional $60,000 exemption, which can save eligible seniors about $938 per year in school district taxes alone. In New York, legislation signed in 2026 allows localities to exempt up to 65% of a home's assessed value. In Illinois, the senior assessment freeze can lock the assessed value permanently the moment the homeowner files. Now run the numbers over time. A senior in New Jersey who keeps $6,500 per year for 10 years keeps $65,000. A senior in Texas who keeps close to $1,000 per year for 10 years keeps nearly $10,000. In Illinois, where the freeze holds down the taxable value while neighborhood assessments rise, the savings can compound because the avoided increase repeats year after year. This is where the issue becomes larger than one tax bill. When you are working, you can sometimes absorb a mistake by earning more. When you are retired, every recurring cost becomes part of a system. A recurring cost that is $1,000 too high is not a $1,000 problem. It is a $10,000 problem over a decade, and it can be even larger when increases stack on top of increases. Most people underestimate recurring leaks. They look for large, dramatic financial events, a crash, a fraud, a lawsuit, a medical emergency, but many people do not lose stability through one big event. They lose it through a series of small leaks that never stop. An unnecessary property tax overpayment is one of those leaks. And here is a detail: many people miss those numbers. Assume the senior files this year. In some states, if you qualified in prior years and did not know about the form, you may be able to file retroactively. In Texas, it can be up to 2 prior tax years. In Illinois, it can be up to 3 for Carol. That meant the possibility of going back to 2021. She was eligible. She had not filed. The law allowed a retroactive application. That means this was not just about saving money in the future. It was about recovering money from the past. That is a very different situation. Many seniors assume that once a tax bill is paid, the money is gone forever. Sometimes that is true, sometimes it is not. And when the rule allows retroactive claims, the difference between knowing and not knowing can be a check. I want to make one thing clear: this is not about beating the government. This is not about tricking anyone. This is not about aggressive tax strategy. This is about claiming a benefit that already exists for people who already qualify. It requires no investment product. It requires no speculation. It requires no promise of future return. It is a form. That is why this story is so important. The senior homestead exemption is not new. In Illinois, the senior citizens homestead exemption has existed since 1994. That is more than 3 decades, and yet millions of seniors still do not know how these programs work. Why? Because property tax exemptions are generally not automatic. The system does not usually track your birthday, your home ownership, your income, your resident status, and then automatically reduce your tax bill when you turn 65. There is no universal mechanism that says this person now qualifies, so lower the bill. No letter arrives automatically in many places. No county employee is assigned to make sure you do not miss it. No one puts a warning on the top of the tax bill saying, you may be overpaying because you have not filed your senior exemption. The county assessor administers the program, but administering is not the same as advertising. That distinction matters. A program can legally exist and still be practically invisible. The burden of finding it, filing it, attaching the right documents, and meeting the deadline falls on the homeowner. That is why the ARP Foundation built a volunteer program around this problem. In the past 5 years, that program helped Americans recover nearly $10 million in property tax relief. Think about what that means. A volunteer effort recovered nearly $10 million because the official system left people behind. That is not an argument about politics. That is a structural observation. When a private or nonprofit effort has to help people claim relief they are already entitled to, it means the system's default setting is not automatic protection. It is passive collection. Now here is where the story becomes worse. Even when seniors discover the exemption, many still lose it because of deadlines. And deadlines in these systems are often quiet. Florida closes the additional senior exemption on the 1st of March. New York City closes theirs on the 15th of March. Texas closes the 30th of April. Colorado can run as late as the 15th of July. These dates vary, and that variability is part of the trap. If every state had the same deadline, people could remember it. But when every county and state uses its own rules, the burden shifts to the homeowner to search, verify, and act. The deadline may not be printed clearly on your tax bill. It may not be mailed to your home if you do not already know to search for it. The window can close in silence. And when it closes, you usually wait another year. But the deadline is not the biggest reason people lose the benefit. It is the second biggest reason. The biggest reason is confusion inside the form system itself. Most counties run several property tax relief programs at the same time. The senior homestead exemption may be one program. The senior assessment freeze may be another. The circuit breaker credit may be another. The standard homestead exemption available to many homeowners may be another. They may sit on the same county website. They may use similar language. They may ask for similar information. They may all be connected to the same property, but they are not the same program. They have different forms, different eligibility rules, different income limits, different renewal rules, and different deadlines. When a senior finds the wrong form and files it, the county does not necessarily call and redirect them. The application is processed as submitted. Then the denial letter arrives. It may say the homeowner did not qualify, but the truth may be that the homeowner qualified for a different program and filed the wrong paperwork. That is the first trap. The second trap is the specific section that gets applications rejected even when the senior found the correct form. Most states that offer senior exemptions have a household income limit. In Illinois, the number used in the source example is $65,000 per year. In New York City, it is $58,399 in Florida. The additional senior exemption requires income below $36,000 per year. Those numbers matter because they create a documentation requirement. It is not enough to say you qualify. You must prove the income. That proof can be a prior year tax return. It can be a Social Security award letter. It can be other documentation the county requires. But if the application is submitted without the proof of income, the application may be automatically denied, not reviewed and returned for correction, denied, closed. One missing document, one automatic denial, one more year of overpaying. That is the part people need to understand. In a well-designed system, an eligible senior who forgets one attachment would receive a correction. Notice in many real systems, they receive a denial. That difference determines whether money stays in the household or leaves the household. Carol S. situation shows the other side of the same structure once someone pointed out the rules to her. She learned that Illinois allowed retroactive applications for up to 3 prior tax years for the senior assessment freeze. She had been eligible starting in 2021. She filed in 2024. The county processed retroactive applications. That matters because it shows the system can correct the past, but only if the homeowner knows the rule, asks for the correction, and files the right paperwork. No one was going to do it for her automatically. That is the central lesson in systems of money. The person who assumes the system will act in their best interest is usually exposed. The person who understands the rules, verifies the documents, and watches the deadlines is much more protected. I would approach this in a practical sequence. First, a senior homeowner has to confirm eligibility. Most states require the homeowner to be at least 65 to own and occupy the property as a primary residence, and in many cases to stay below a household income threshold, but the specific rules must be checked locally. Because these programs are state and county driven, a number in Illinois is not a number in Florida, a deadline in Texas is not a deadline in New York. The principle is national, but the procedure is local. That is why the official county assessor's website matters. A third-party site may be outdated. A blog may simplify the rule. A search result may mix one county's form with another county's deadline. The safe path is to go directly to the county assessor or county property appraiser's official government website. Search the county name with the words Senior Homestead Exemption Application and the current year. Then verify whether there is also a senior assessment freeze, a circuit breaker credit, or any other age-based property tax relief program. The reason to check all of them is simple. A homeowner may qualify for more than one. Carol did, many people do. But if they only file one form when two benefits exist, they may still leave money on the table before opening the form. Gather the documents. Proof of age can be a driver's license, state ID, birth certificate, or whatever the county accepts. Proof of ownership can be the deed, the most recent mortgage statement, or property record documentation. Proof of residence may be required to show that the home is the primary residence. Proof of income is often the document people miss. That can be a prior year tax return, a Social Security award letter, pension statement, or other required record. Do not assume the county will ask later. In a fragile paperwork system, the safest method is to attach everything required before submission. Then find the exact county deadline, not the state deadline from an article. Not the deadline from last year, the county-specific deadline for the current filing year. Write it down, put it on a calendar, set a reminder before it. Because the system usually does not care why you missed it. Finally, submit directly to the county office. That may be online, by mail, or in person depending on the county. If there is an option to receive confirmation, get confirmation. If filing in person, ask for a stamped copy. If filing by mail, use a method that creates proof of delivery. If filing online, save the receipt or confirmation number. This is not paranoia, it is good process. In money systems, documentation is protection. Now let me go back to the bigger point. A property tax bill can feel like nature. It arrives every year. It has official language. It has numbers, parcel IDs, assessed values, dates, and penalties. Because it looks official, people stop questioning it. But an official bill can still be higher than it needs to be. The number can be legally calculated and still fail to account for a benefit you never claimed. That is why this is not only a senior tax story, it is a story about how wealth leaks out of households when people do not understand the system around them. A retired teacher like Carol may be careful her whole life. She may work for decades. She may buy a modest home. She may pay every bill on time. She may avoid speculation. She may do everything people say is responsible. And still, the system can quietly take thousands of dollars more than it needs to take because one form was never filed. That is not a failure of character. That is a failure of information. And information asymmetry is one of the oldest forces in money. The person who knows the rule keeps more of the money. The person who does not know the rule funds the system for younger people watching. The lesson is not only to help parents or grandparents check this form, it is to understand the broader principle. Do not assume a bill is optimized for you. Do not assume a default option is the best option. Do not assume that because a benefit exists, the people who qualify will receive it. They often will not. Defaults are powerful in retirement accounts. The default contribution rate affects how much people save. In insurance, the default deductible affects what people pay. In mortgages, the default escrow amount affects monthly cash flow. In property taxes, the default is often no exemption unless you claim one. That default is expensive, and for senior homeowners, it may be the difference between staying comfortably in a home and slowly being pressured out of it by rising fixed costs. If you are a senior homeowner, or if you have a parent, neighbor, or relative who is, the question is not whether they are paying property taxes. The question is whether they are paying the correct amount after every available exemption has been claimed. That is a very different question. It is not enough to ask, did the bill arrive? You have to ask, was the assessment correct? Was the exemption applied? Was the freeze filed? Was the income proof attached? Was the deadline met? And was there a retroactive claim available? Those questions are boring, but boring questions often protect real money. The mistake many people make is thinking that financial security comes only from earning more, investing better, or taking more risk. Sometimes financial security comes from closing leaks, and a property tax exemption is a leak that can be closed without buying anything. No stock, no fund, no annuity, no complicated financial product, just a rule that already exists. When I think about Carol, I do not think about a woman who needed a complicated wealth strategy. I think about a woman who needed the right information at the right time. The county did not bring it to her, a neighbor did. That one conversation changed the direction of her tax bill. That is why sharing this kind of information matters. A person who never needs this form may know someone who does. A son or daughter may be able to help a parent file it. A neighbor may be able to help someone who is overwhelmed by websites and documents. A church group, senior center, or local volunteer may be able to prevent thousands of dollars from leaving households that cannot easily replace it. That is how small pieces of financial knowledge produce large practical effects. The form is not dramatic, it is not exciting, it will not trend like a stock tip. But for the right household, it can matter more than any investment idea they hear this year, because a guaranteed reduction in a recurring bill is one of the cleanest forms of financial improvement. If a senior saves $1,000 per year through a property tax exemption, that is not the same as trying to earn $1,000 in the market. There is no market volatility. There is no trading timing. There is no earnings risk. It is a structural reduction in outflow in personal finance. Reducing a recurring outflow can be as powerful as increasing recurring income. The final pressure is this: the window does not stay open forever. Every year has a deadline. Every state has its rules. Every county has its forms. And every missed year is another year the money leaves. If someone qualifies and does nothing, the system does not stop. It continues. If someone files the wrong form, the system does not necessarily correct them. It denies. If someone forgets proof of income, the system does not necessarily wait patiently. It closes the file. That is why the correct response is not panic. The correct response is process. Find the official county website. Find the senior exemption, find the assessment freeze, check the income limit, gather proof of age, ownership, residence, and income, verify the deadline, submit with confirmation, ask whether retroactive filing is allowed. Then follow up until the exemption appears on the property record or tax bill. That is how you turn a hidden rule into a real reduction. And if the county denies it, do not simply assume the denial means you were never eligible. Read the reason, check whether the wrong form was filed, check whether a document was missing, check whether a different program applies, check whether there is an appeal or correction process. Because the denial letter may be the end of the county's process, but it does not have to be the end of your understanding. The important thing is to see the machine clearly. The machine does not hate you, but it also does not automatically protect you. It rewards the people who know the rules and act before the deadline. Carol paid too much for years because she did not know. Millions of senior homeowners are in the same position. Some are overpaying by hundreds, some by thousands. Some may have retroactive money available and no idea that it is sitting behind a form they have never filed. That is why this matters now. Not next year, not when the next bill arrives. Now, because once the deadline closes, the year is gone. And for a senior on a fixed income, a year of overpayment is not a small thing. It is money that could have stayed in the house, money that could have paid for medicine, money that could have reduced stress, money that could have made retirement less fragile. There are many ways people lose wealth. Some lose it by speculating, some lose it by borrowing badly, some lose it by panic selling, but many lose it by never learning the quiet rules that were sitting in front of them the whole time. This is one of those rules: a form, a deadline, a proof of income attachment, a retroactive window, a senior homeowner who either knows or does not know. That is the whole difference. And in systems like this, that difference can be thousands of dollars a year. So do not treat the property tax bill as the final answer. Treat it as the first question. Ask what exemptions apply, ask what freezes apply, ask what proof is required, ask what deadline controls the year, ask whether prior years can be claimed, because the homeowner who asks those questions may keep money that the passive homeowner will simply send away. That is not luck, that is understanding the system. And once you understand the system, you stop being only the person who pays the bill. You become the person who checks whether the bill should have been that high in the first place.